Every property you buy is making or losing you money in 4 different ways, and it's happening whether you like it or not. Now, I'm going to break down these different wealth engines so you can see where it's coming from and how to optimize for each one so you're not leaving thousands of dollars on the table. Now, I own over 150 rental units, and this is the one thing I know for sure. Real estate will always work in your favor in the long term. Blue skies ahead. But getting off the ground can be brutal. You need to stack the odds in your favor. So grab your notebooks. Let's get into it. Wealth engine number 1. Now, everybody hates inflation, but if you're a real estate investor, maybe not so much. Now, I used to buy a whole bunch of eggs, like dozens per week, because I was trying to get huge, and I used to buy them for $1 a dozen. And just a few months ago, I went to the store and it was $6.50 for that same dozen eggs. And that's what happens. Inflation, the cost of living, continues to rise and rise and rise. But for us real estate investors, you don't call it inflation, you call it appreciation. Because you see, the houses that you own, they're always climbing in value over the long term. Now, there are going to be dips, i.e. 2008. Sometimes the market dips. So you have to be prepared to hold on to the long term for this market appreciation. All right. Over the last 40 years, the market has appreciated on an average of 4.27% per year. That means that if you bought a house for $300,000 today, which is like the median, in 30 years, when your mortgage is paid off, that house would be worth around $900,000. Yeah, pretty awesome. Just want to say that again. That's over the long term. There are going to be dips in that long-term chart. All right. Now that's market appreciation, but there's actually 2 types of appreciation. The second one is forced appreciation. Now remember that property is steadily appreciating over time. This is like a 30-year mark. It's continually going up over 30 years. But what forced appreciation means is that you, at some point on that line, you decide that you're going to improve that property. You're going to move it up. It will continue to move at that same pace afterwards, but you have stepped it up in value. This is like when a business goes and invests heavily into their brand to increase the value of their company and their brand equity, like Cracker Barrel, for instance. Right. Yeah. Sometimes your investment turns south on you. That is an important point. All right. When you're trying to force equity into a property, force appreciation into a property, sometimes the market can turn south on you. If you're trying to make short-term gains, the market could work against you, or your investment could work against you. You could put the wrong money into a property. That's why I have this channel, is to make sure you're spending money properly to increase the value of that property. But anyway, I don't care what they tell you. Over the long term, real estate is always going to win. So if you can buy and hold on for 10, 20, 30 years, that property will raise in value. But here's the problem. Appreciation is wealth generation on paper. It doesn't do you any good when you go to buy groceries. So let's move on to wealth engine number 2. This is cash flow. And there's actually 3 ways to generate cash flow from your properties. One is obvious, your rent income, your NOI, net operating income, which means the rent money that you receive from a tenant. So let's say they pay you $1,500 a month to live there. Well, think of it like when you go buy a bag of Doritos. You get a big old bag of Doritos, you're pumped about it, and then you open it up and you only get like a third of it full of chips. That's kind of like what happens when you get your rent money. You get the $1,500, but then you got to go pay for property management. You got to pay for maintenance. You got to put money aside for CapEx. You got to pay your taxes, property taxes. You got to pay your insurance. You got to pay, or at least put money aside for vacancy, because people don't live there indefinitely. They move out. You have to fix it up a little bit, and then you have to put it back on the market. Maybe you have to pay a listing fee, or maybe you have to pay a lease up fee to a property management company. So you don't get the whole bag of chips. You only get some of them. That is your NOI, your net operating income. So that's rent. Next is you could sell the house. Flippers. That's what flippers do. And you could flip a house really quickly. Like you buy it, you fix it up, and then you sell it a few months later. Or you could buy it, rent it out for a year, maybe 2 years, and then sell it. You put your flip on the shelf for a couple years. But when you sell that property, you get some money in your pocket. Now, same thing with the bag of chips. You got to pay a real estate agent to sell it. You got to pay the buyer's real estate agent. You got to pay closing costs. You're going to have to pay a lot of taxes. And then, of course, the project cost of actually doing the rehab on it. All right. Now, the third way is mitigating those taxes. All right. This is probably one of the biggest, most important concepts that you're going to learn as a real estate investor. You see, recently, Elon Musk took out $12 billion of personal loans. Why the heck would he do that when he owns Tesla and SpaceX and XYZ, all kinds of other companies? Why would he take a personal loan instead of just selling some of the stock or some of the other assets that he owns? It's because when he sells some of that stock, he has to pay capital gains taxes on it, which is going to be pretty high for somebody that makes a lot of money. And so instead of doing that, he takes the valuation of his stock and he goes to a bank and he says, hey, I control all of these assets, so give me a loan based upon that. And that's exactly what you do with your property. Your property is your Tesla. You go to the bank and say, hey, this is worth $300,000. Will you give me 70 or 80% of that in a cash out refinance? But here's the best part, is that cash is not considered income. When they give you that refinance, it's considered debt. And the IRS does not tax debt. They only tax income, which leads me to the third wealth generator, which is the tax advantages of real estate. Now, I'm not talking about tax refunds here. You're not going to get those as a business owner. That's what happens when you're an employee and you overpay all year for your taxes, and then they give you some of it back after probably earning interest off of all the money you overpaid them all year. No, this is more of a defense than an offense. I like to think of, Muhammad Ali. Most people think of him as like a great offensive boxer, like float like a butterfly, sting like a bee. But the reality is he was one of the best defensive boxers. He used a strategy called the rope-a-dope. And basically he would sit on the ropes, kind of lean back and let people miss him. And they would get so tired and eventually he'd go on the offense and knock them out. But the point is that his defense led him to maintaining all of his energy when his opponent ran out of energy, and he was able to go on the strike when it was necessary. Now, that's the same thing with tax advantages. You are able to save your energy, save your money, so you can go invest it wisely. And to use one more sports analogy here, sometimes the best offense is a great defense. There are basically 3 levels of tax advantages. Number 1 is available to really any business owner, not just real estate investors. But this is like getting a lifetime 40% discount. It's a straight up write-off on anything that is related to your business. And people get a little bit gray with what's related to their business. But this is repairs. This is your tools, office expenses, your vehicle, the gas you put in your vehicle, sometimes meals, going out to eat for lunch if you're doing a business meeting, etc. Literally anything that has to do with your business. You do content for your business, those cameras are free, baby. Don't get carried away. By the way, you still have to buy the camera. You just don't have to pay taxes on that amount now, right? Let's say you made $100,000 in a year and you bought a $1,000 camera. Well, now the IRS says you made $99,000 instead of the $100,000. You see how it's a 30 to 40% discount? All right, level number 2. These are tax deferrals. This is kicking the can down the road. You get it? This is like the Elon Musk example. He took a loan out against the stock. Eventually, one day, he will have to sell the stock. When he does that, then he will have to pay taxes on it. It's a deferral. It's kicking the can down the road. A little side note, there is a way to possibly never pay those taxes. It's a strategy that people implement called buy, borrow, die. We're not going to get into that right now. 2 main types of deferrals. There's depreciation on the property. All right, basically the IRS says that the land is great. Land is great. But the building, the structure, the house or the multifamily home, the apartment, whatever, that sits on that land is depreciating in value. It's getting worse every day. Even though you might have done a brand new renovation on it and it looks great, everything's in great order, the IRS still says that's depreciating in value. So for a residential property, they'll say that you take the value of the property. So just easy example here. Let's say it's $100,000. That's what the property is worth. It's been appraised at $100,000. I know, not a realistic example, but great for math. And they're going to say, okay, 30% of that $100,000 is the land, $30,000. And the other 70%, $70,000 is the building's value. And we're going to say over the next 27 and a half years, you get to depreciate that amount. Basically, you get to write that amount off of your taxes. Well, let's do some math here just to make sure you got it. $70,000 divided by 27.5. Every year, you get to take a loss of $2,545. 2,545. Sweet, right? It's a phantom write-off. Other type of deferral is 1031 exchanges, a like-kind exchange. Usually when you sell a property, you have to pay capital gains taxes on it for whatever profits you had. But in a 1031 exchange, basically you go and sell that $100,000 house. You can buy something that is of equal or greater value within a whole lot of parameters. Look up the rules here. We're not going to get into that today. It's usually like within a certain amount of days, you have to identify the next property you're going to buy. But if I buy another property that is $100,000 or more, I get to take all of those proceeds and transfer them over, skipping paying taxes on those capital gains. Sweet. Third level are actual tax breaks. Like you don't pay it today and you never pay it. First is capital gains. So pretty much on anything that you make money on, you're going to have to pay your ordinary tax rates on. If you flip a house, ordinary tax rates, there's strategies to get around that. But just in general, you're going to pay ordinary tax rates. Just like you had a job with somebody, got paid $100,000 that year, you're going to pay based upon the ordinary tax rates. But the cool thing with investment, not just real estate, stock investment as well, and other types of investment, instead of paying the ordinary tax rates, you pay long-term capital gains rates, which are much, much lower than ordinary income. All right, so that's your first break if you decide to sell. The other one is the single greatest tax advantage ever. I don't know any better tax advantage than this. That's selling your primary residence. If you have lived in that house 2 out of the last 5 years, you get to take $250,000 as a single person or $500,000 as a married couple of profit put in your pocket and not pay a dime of taxes on it. No strings attached. Literally, you buy a house for $100,000, whatever, you work on it for 5 years as you live there, or a big spike in the market happens and it sells for $600,000 a few years later. You get to take that $500,000, the $600,000 minus the $100,000, put it in your pocket and never pay a dime of taxes on it. Couldn't be a better tax advantage than that. The only way to get your money off the table and not have to pay somebody that I'm aware of. But the real reason that you want to buy real estate is the fourth advantage, what I call the invisible 401k. Everybody knows what a 401k is. You get your job, they have a 401k set up. Every month, you get to stash away some money. At some places that you work, the employer actually matches the amount that you stash in there. Pretty awesome deal, right? And then after years and years and years of discipline, finally, you have your nest egg and you get to go retire. You work your whole life to retire. You got your 401k. Classic American story right there, right? Well, just imagine that you didn't have to put any money into that 401k, but it just kept growing. In fact, you didn't have to wait 30 years. You didn't have to wait till you retired. You could take it at any time. Well, that is exactly what happens with this fourth wealth engine, the equity buy down, the net worth gap. All right, here's basically how it works. Simple example here. You have this house that you bought for $300,000. All right, you have a loan on it for, let's say, $280,000. right? The bank gave you money to go buy that house. It's generally on a 30-year mortgage. And remember, we're adding up a lot of things here. Remember that 4.27% per year of appreciation. So that house is going to, in 30 years, be worth $900,000 instead of the $300,000 that it's worth today. Okay, so that's going up. You put a tenant in that property, and every month they give you rent money. You use that rent money to pay down the mortgage, and then over 30 years, that mortgage goes to zero. That's the equity pay down. So every single month, the gap gets bigger and bigger and bigger and bigger. Your net worth gets bigger and bigger and bigger and bigger. And you're not even putting money into it. It's the tenant that's giving you the money to put into it. That's the equity buy down. Now you might be thinking, oh, well, what about my personal house? Great. You were going to pay rent anyway. So that money was already gone. Nobody's living for free. So you're paying rent to the bank for 30 years and the appreciation is happening. The equity is increasing. It's great. It doesn't get any better than real estate. And I'm sure you caught this, right? The bank would give you the $280,000 to buy that property. There's not other investments where the bank is just going to shell out money. Why? Because they know the same thing as I know, is that it is the best way to invest. It's the safest asset class because you have control over it. You can go affect change in that property. And here's the best thing about real estate. It's got the Mario rules. The Mario rules, basically, when you're playing Mario, not a video gamer, but I know this, that once you pass a checkpoint, well, next time you die in that game, you only go back to the checkpoint that you most recently passed. You don't go all the way back to the beginning. Same thing with real estate. In the toughest times of my life, when I thought, oh gosh, I'm going to lose it all I had to do was think, oh wait, but I own those properties. So I don't go past that, right? I already have it in the bag. I'm already, once again, gaining equity every day that I just hold on. So I never go back to zero. I'm at a next checkpoint. So every property I buy, that's what I'm thinking. Next checkpoint, boom, checkpoint, boom, checkpoint, boom. So I mean, what the hell are you waiting for? Go buy real estate. And that's why Andrew Carnegie, one of the greatest businessmen of all time, said that, and I quote, 90% of all millionaires became so through owning real estate. So don't take it from me. Take it from that guy. Makes perfect sense. All right, guys, 4 ways to make money. It's great. But like I said, you could lose money by doing this if you do it wrong. In the long term, always going to work out for you. But it is getting off the ground that can be absolutely brutal. So you have to stack the odds in your favor. You have to have the tactics. You have to have the knowledge. You have to start gaining skills. That's why I made this channel. I make all kinds of videos about what you should do and what you shouldn't do, the strategies, the frameworks. So please check out this other video. Thanks for hanging out.